Hello everyone. Today we're going to talk a little bit about this pause for breath that we're seeing in the markets and the macro implications that we are actually seeing that defend our position relative to the US dollar and the US markets in particular. We have seen the markets, the US market in particular, get a little bit less exuberant, a little bit less optimistic, specifically because of the opposition to the change of the Affordable Care Act in Congress, because of the inability to repeal Obamacare. Let's face it, Obamacare is going to be repealed by reality, economic reality. Why? Because in the period between 2015 to 2025, it is expected to generate a net deficit of more than $1.2 trillion. So it is not a question of changing it in Congress. It has to be changed. No matter what we see, in any case, what is a reality is what we have been saying since the beginning, is that the administration will have to gather a larger consensus within Congress, with the Republican Party, in order to continue to put these measures that are so badly needed for an economy that is growing way below its potential. So, supply-side economics, tax cuts, improvements in the healthcare system, and the budget are three key elements that, as we will see in the next months, will continue to help the economy to gather the momentum that we have seen in the last months. Consumer confidence, business confidence, leading indicators, ISMs, all of them are pointing towards a stronger dollar, stronger market, stronger economy in the US. So let's keep that in mind. In Europe, we need to be quite less negative. I think that what we're seeing is an improvement in the economy that is much better than what we expected. We're also seeing earnings much better than what we expected, and the risks that come from political catalysts look to be less of a concern than that many expected before, particularly last year. So let's put in context those risks, because at the same time, money supply is growing in the European Union at around a 4.9%. So we are taking this pause for breath in the markets to take more positions, to take a little bit more risk into those assets that we like. We continue to be less than positive about oil, despite the cuts, despite all of the messages from brokers. The reality is that the market is well oversupplied, and we continue to be positive about the US economy, positive about the changes that will come from supply-side measures, and positive about what that means for investment, for jobs, for companies' earnings, and for multiples. And as we see the bond bubble bursting, as we see less and less interest from investors into low or negative yield bonds, what we are likely to continue to see is taking a little bit more risk into equities, into this stronger dollar, stronger earnings, stronger equities environment that we believe will likely continue in the next months. So pause for breath, an opportunity to take risk in those areas that we like. Thank you very much.